Hi, I'm Jonathan Wernick, Global Equity Analyst at Sasfin Wealth, and today we're going to be talking about global equity markets and also the Sasfin Global Equity Portfolio. And to help me with that exercise, as always, I'm joined by my colleague Craig Pheiffer. Hi, Craig.
Hi there, Jonathan. A little bit gloomy outside while we're recording this, but I think it was a bright quarter for the portfolio.
Quite right, Craig. The first quarter was quite positive, good start to the year. I think global equity markets were up about 8% or so. Maybe you can just take us through some of the reasons for the strong performance.
Well, it was mostly, again, the story about interest rates. And I think the flow through and the positivity that we got from the end of the year, where the markets generally started anticipating that 2024 was going to be the year now where interest rates would finally pivot and turn lower, and then central banks around the world would start reducing interest rates. We'd get a couple of interest rate cuts across the board, and that would help spur growth again, boost earnings, and happy days for all in the markets. I think as time is playing out, we're kind of pushing those interest rate cuts out a little bit more towards the end of the year. And the market's kind of living and dying by these expectations and those changes in expectations. But generally the underground or the underlying feeling is that it's still positive. Rates are coming down this year, and the markets are taking their cue from that. I think also generally positive takeaway on the earnings front that we got at the start of the year. A couple of outlooks that were scaled back a bit for this year, but generally positive earnings outlook as well for the full year.
Last year, the market came to know the Magnificent Seven. The gains for the market overall were considered to be fairly narrow. Those 7 companies, the likes of Amazon, Meta, Nvidia, Tesla, Microsoft, Alphabet, might have missed one there, but they were the big gainers last year. This quarter, though, it's been a little different. I think gains have been a bit broader. Some might be saying that the Magnificent Seven has now become the good and the bad and the ugly, with only the likes of, I think it's Nvidia, Microsoft, Amazon outperforming the broader market. Alphabet, we say bad, maybe they're not so bad. They're just slightly underperforming. But then from the bad front, the likes of Tesla and the one I did forget, Apple, not having a good quarter. That being said, though, if we bring things a bit closer to home to our global equity portfolio, we did outperform the broader market this quarter. And sticking with those companies and maybe just broadly the AI theme, the information technology sector was the best performing sector during the quarter. And a lot of those names you've mentioned already, Nvidia, Amazon, Microsoft, Meta, all performing well. But also the likes of Constellation Software, ASML, another semiconductor company, having a good quarter. But beyond information technology, the consumer discretionary stocks, particularly the luxury stocks, had a good quarter. Maybe you can just touch on that a bit.
Yes, I think they had a good quarter, maybe just a little softer towards the end, with some concerns coming out of China. But, those companies, and it's a space that we've been looking in, and we'll maybe talk a bit later, where we delved more into investing in that luxury space. But it is, a sector traditionally that's expected to outperform when economies slow, given that, the rich are always going to want their goods and their goodies, their expensive goodies in their bags and their shoes and whatever, and their expensive watches, and they're kind of immune to economic cycles. So sometimes those are stocks that do well, and we had a good quarter in them this year so far. As I say, I think towards the end of the quarter there was a little bit of noise coming out of some other luxury stocks that we don't own, like Kering, talking to just a bit of softness in demand in China. And I think that softer Chinese demand has played out in a lot of different stocks, not specifically just the ones we hold, but those that have got a reach into China have certainly felt a slowdown in demand for their goods and services.
And sticking with consumer discretionary, another stock that had a good quarter, Home Depot. I think the US housing market maybe stabilizing a bit now. It's been through a bit of a tough patch with interest rates going up so much. There's a whole debacle with the real estate or realtors in the US. That was the positive. It wasn't all positive. There were a couple of negatives during the quarter. Starting off with the consumer staple stocks, the likes of Philip Morris, Diageo, Nestle. We own those names. Difficult quarter for them. Maybe you can just touch on the reasons for that.
Yeah, difficult quarter for them, and stocks that we've been eyeing as, we've been questioning whether their growth rates are really at the level that we want and are, going to be sustainable at a higher level. And, we've had a few question marks around that. And for that reason, we got to, the Philip Morris case. And that's an industry or a sector where essentially it's in structural decline. People are smoking less. There's a big move towards more these heat not burn and all these other alternatives to your flaming cigarette. But at the end of the day, in a stock like Philip Morris, we didn't see that growth that we want out of the longer term. And that's why we actually exited Philip Morris in this quarter. And the same for Diageo. Also at the back end of lower demand and just not on the outlook that we've got or we want, not having that level of growth that we want to see from a stock. So we exited that. The whole thesis or philosophy behind our portfolio is that we want quality growth stocks that have, they've proven their growth over the past, and the outlook is also for them to have, higher levels of growth and higher levels of reinvestment. And we didn't see that in the likes of Diageo and Philip Morris, so we exited those in the quarter. And we also have question marks about Nestle, so that one's also under the microscope at the moment.
Yes, that's quite right. And I think it was broadly a bit weak for consumer staples. But maybe more narrowly, some of the stocks that also didn't do quite well this quarter. Nike had quite a challenging one. Apple is going through a bit of a tough patch at the moment, a lot of headwinds blowing its way. Another company that had a difficult time, United Health, it faced quite a big hack which interrupted its operations. More people are utilizing their insurance, particularly the elderly, so that's affecting their costs, having to pay out a bit more. And the whole thing with the US elections and could there be a potential change or healthcare reform in the US just creates a bit of a cloud over United Health.
Right.
But just maybe closing off on a positive note, another stock that had a good quarter, Disney, maybe just a few points on that because I think it's going to segue nicely into the changes we made.
Yes, Disney's a stock that we've been on, when I say on the fence, we realized the value in the stock. We've placed question marks about the longer term growth of the stock and just the price that it's been trading at. It looked to be trading at a decent discount to its intrinsic value, but it's also a company that's been and is on a journey, particularly on their streaming side. There's a whole industry around streaming. They are likely just turning profitable this year on streaming, but there's been question marks about how much they invest in that. It's been a loss-making business. They have the whole television business, ESPN, huge cost for them also to take up these licenses for all the big sporting events. One questions the parks, how much more you can just put up the prices. They have limited capacity, but are they really making this now actually more like a luxury good? Some of the prices of that, to get into there. And on top of all of that, they've had, sort of attacks from outside on their board, disgruntled investors looking for them to change their strategy. But with all of that, I think most of the news has been quite positive and it's driven the share price up nicely to a point where we've looked to realize that value that we've got from the discount that was trading at. It moved up quite nicely, and we still have question marks about the longer term growth, so we cut that one in the quarter as well.
Well, yes, I think that's what I was alluding to. So Disney had a great quarter. We realized the value and we were able to exit at what we deemed to be at least a fair price.
Right.
So Disney was one of the names that left the portfolio during the quarter. And just on that, typically we're not that active in the market. We tend to buy companies and hold them for a long period of time. We don't like to be going in and out. We're not traders. But this quarter was a little unusual from that perspective because we made a few changes. We sold 3 companies and we bought 3 new companies. Disney was the first one I mentioned. Maybe we want to touch on the other 2 companies that we exited during the quarter.
Yes, that was Diageo and Philip Morris.
And you've mentioned the reasons.
I've mentioned those. So those were the 3 stocks that we got out of, and also to make room for some new ideas. And we constantly, as you know, looking at opportunities to improve the quality and the growth outlook of the portfolio. So we're analysing companies, on a day-to-day basis. We're analysing the results that come out, looking for those new opportunities. And a couple did come along in the quarter.
And so before we go on to those, just to, you've touched on it already, but I think we've got a philosophy that we want to hold quality growth names. And those names that we exited, we just felt that, yes, they were quality stocks, but maybe the growth just wasn't quite there, wasn't up to the standard we were looking for. But the companies we have added, we're quite excited about from that perspective. And maybe just to start off with the first name of the 3 that we added, Ferrari, maybe just tell us a bit about that.
Yes, Ferrari. So, it's listed as an automaker, but it's very much more than just producing automobiles and cars. It's a luxury goods company through and through. And it's all about, buying that car with that prancing horse logo on the front and just being part of the culture. And Ferrari does have that whole excitement around it. It's got the Formula One aspect to it as well. And there's a long waiting list. You almost get invited to buy a Ferrari these days. Otherwise, if you're not on the list, you got to wait some time. But these are big ticket items. They maintain or hold the quantity. They don't just build them and flog them. And they manage the market and just the whole perception around the brand very, very, very carefully. And that's why it's a really desired good amongst the rich and famous and those who can afford Ferraris. And even if you can afford one, you have to be lucky enough to get one, to be on the list to get one. So it's a stock that has that big wide moat that we like to see as well around companies, and those long-term growth prospects. So the quality's there, a good history of quality and growth, and as I said, we look to the future as well, and the growth outlook is also positive.
Now, Ferrari is a very well-known brand. It's hard not to get excited just thinking about it. But another stock we added that probably most have not heard of before, but they're certainly going to be hearing a lot more of it in the future. A company called Novo Nordisk. Without giving too much away, just tell us a bit about the company. It's based in Denmark. And what are they doing that's probably going to be a big change in the world going forward? We've already seen the big change taking place.
Novo Nordisk is a company with a 100-plus year history. Quite simply, you could think of it as just a pharmacy or a pill producer.
Mostly in the diabetes space, correct?
Starting in the diabetes space is their biggest product at the moment. But, they've been producing drugs over a long time. They get the patents for those. Those patents expire. But while that's happening, they build up their portfolio of new drugs. And so it goes on. And the good companies, manage to do that, and you get a 100-year history. Stock like Novo Nordisk was in the diabetes space. Well, they still are, and producing drugs for that diabetic market. But they found while they're producing this and people using it actually lost weight using their drugs. And they have now sort of branched off a little bit into weight loss drugs using the same underlying pharmacological actions, and semaglutide, if the truth be known, is the magic ingredient. And that's now spawned a whole new industry of people who really, and it's a high ticket item as well. It cost a fair bit for the drugs, but the rich and famous and the others can afford that. And it's also a drug that you likely need to stay on to keep your weight off. So there's an increased demand for some a product that they very much had already produced. So now they continue with the diabetic side, but they're also, producing the weight loss drug. At the moment, it's, they're looking for different ways to deliver it, from, injections rather to pills and things like that. But the market in itself is now in a strange position where, you've got this demand on the weight loss side, but it's actually taking away from the production or the availability of the drugs on the diabetic side. Maybe not a good thing, but it just shows you the demand for their product. And there is, there's only one or two or three companies in the space, offering these weight loss, let's call them miracle weight loss drugs at the moment. But, even outside of this, we see quite a future for these weight loss drugs. But generally the company as well, it's got the DNA that we like in terms of a long-term growth and sustainability.
And just for those that are wondering what the drugs are and they want to get hold of them, it's Ozempic and Wegovy. But good luck trying to find some in this country at the moment. The final company we added in the technology space, a company called Adobe. Maybe just want to touch on some of the reasons why we included that in the portfolio.
Two of the big themes in the market at the moment that have been driving the market have been weight loss drugs and also artificial intelligence / semiconductors. And we are quite overweight in that space. Well, we've got a good presence in the portfolio in that space. And Adobe was just a stock that we looked at also in our screening of quality growth companies. It did show up. It's one of those stocks, though, that the market's a little undecided on whether artificial intelligence is really going to be the end of Adobe, or Adobe is going to use artificial intelligence within its many products, and come out on top as well. So some of that skepticism actually pulled the price down to where we thought it was, decent buying levels based on its intrinsic value. And our outlook and our stance is that we think the artificial intelligence is going to help. It's going to be a positive for the company.
Maybe just to take a step back.
Say what they do.
Well, the name probably rings a bell with some. I'm sure I've heard of Adobe before. And if you work with any PDF document, you're probably quite familiar with Adobe in some form.
Right.
And if you're a creative type, graphic designer, marketing, you've definitely heard of Adobe. But you mentioned artificial intelligence. And I think initially when we had this so-called iPhone moment in artificial intelligence, end of 2022, particularly around this concept of generative AI, the ability to generate content through basically a text prompt. There was a lot of excitement and hype that came with it, and Adobe was initially thought to be one of the potential winners, especially when they came out with their AI model called Firefly. And for a while, it actually really gained a lot of traction. The stock price went up a lot. But you've seen, for a couple of reasons, you've seen their growth slow down a bit. Nothing really to do with artificial intelligence. I think it's more a lot to do with a bit of a COVID overhang and one or two other reasons. But you've seen their sales growth slow a little bit. And you've also seen a lot of competing products come out there, and a bit of concern around Adobe's, how strong their position really is. From our perspective, though, the idea or the concept of being able to generate the content merely through a text prompt, I think it comes back to your philosophy or how you think AI is going to play out. Is it going to lead to a lot of job losses, or could it potentially lead to even more jobs? And as far as Adobe is concerned, I think I tend to lead to more jobs, because if you go back to, probably before I was born, but initially when spreadsheets came out and people saw the potential for spreadsheets, one would think that's the end of accountants. You can do everything in a spreadsheet. But I think if you look around, there's still a few accountants hanging around. I think they actually multiplied in numbers. And the same thing could happen with these creative tools. You might actually see a lot more creatives, people that maybe weren't able to in the past, being able to use these tools for creative purposes. So we think Adobe is actually well positioned with this generative AI move and the tools they've been able to create from it. So we're quite excited about Adobe. And as you mentioned, we think we've got it at least a fair price. Those were the three companies we've added. we've spoken quite a bit about the past, but maybe just a few comments on our outlook, the way we see things ahead. What are your thoughts?
Well, I think we still have a positive. I mean, the markets started off very well for the first quarter. I don't think we're going to see the whole year out at the same clip, at the same pace that we've seen the growth in the first quarter. But, looking to the next earnings reporting season and the two thereafter for the rest of this year, we're expecting growth to continue to pick up, accelerate. If we get positive growth in this quarter that's coming up now, we will see reporting on the first quarter. If we should get positive growth. It'll be the third consecutive quarter of growth, and we expect to build on that in terms of the magnitude of the growth over the rest of the year. So that gives me some comfort that we've got a strong fundamental underpin to the market. At some point in time, we may push out those interest rate cuts a little bit, but they are coming in time, and that will also be supportive of the market. And hopefully we'll see more global growth and supporting that company growth as well going forward. So I think there's a positive market outlook, and we're just going to stick to our knitting and the philosophy around and the way we manage the portfolio, continue on the quality and growth path.
Thanks, Craig. I think that's a great note to end on. And if you do want to read more about what we've discussed today, you can read in our quarterly newsletter. But until then, we'll see you in the next quarter. Goodbye for now.